Zambo, and welcome to our panel discussion on conventional monetary policy, tools, effectiveness, and implication. So, in today's episode, we aim to critically analyze how central bank have response to extraordinary economic challenges by adopting unconventional monetary policy tools. These measures, which go beyond traditional interest rate adjustment, have become essential in addressing issues such as low inflation and financial instability, especially in the wake of 2008 global financial crisis and more recent economic shocks. So our discussion will stimulate a professional panel featuring several panelists, each bringing diverse perspective and insight to the table. Over the next 20 to 30 minutes, we will explore at least three major unconventional monetary policy tools such as quantitative easing, negative interest rate, and forward guidance. We will also consider the effectiveness and potential of these policies, drawing on current research and recent development to provide a comprehensive overview. As we proceed, we are encouraged to reflect on the implication of these unconventional policies for economic, financial market, and society at a large, whether we learner, policy enthusiast, or simply curious about how understanding might spark your curiosity about one of the most important topics in contemporary economic policy. So now I will let our panelists to do their introduction.
Hello everyone, I'm Tasrin. I currently work as an economic analyst at the Royal Monetary Authority of Bhutan, where I specialize in monetary policy research.
Hello everyone, my name is Tishnubu. I am a senior banking officer at Bank of Bhutan, specializing in risk management and financial stability.
Greetings to you all. I am Sangit Injin, currently working as a policy researcher at the Ministry of Finance, and I'm happy to be a part of this panel discussion.
Thank you all panelists for your introduction. So to begin, let's clarify what you mean by unconventional monetary policy and why did central bank adopt these tools?
Thank you, Tenzin. Unconventional monetary policy refers to measures that go beyond traditional interest rate adjustments. After the 2008 global financial crisis, central banks faced zero or even negative interest rates, so they turned to new tools like quantitative easing, negative interest rate policy, and forward guidance to stimulate economies where conventional tools were exhausted.
Basically, as he mentioned, these tools become essential when inflation was persistently low and growth sluggish. For example, the European Central Bank, Bank of Japan, and the US Federal Reserve all adopted quantitative easing and other unconventional tools between 2008 and 2022.
Unconventional monetary policy, it is not just only used by a big economy, but it is also used by a small country like Sweden. For example, before Sweden implemented unconventional monetary policy, their inflation rate was below 2%, and their economic growth was also moderate and stable. After implementing or adopting unconventional monetary policy, such as a negative interest rate and a large-scale asset purchase, inflation began to rise, reaching around 2.2% in 2017, and the GDP growth rebounded significantly, with the output increased by approximately 4.2% in 2015 compared to 2.4% in 2014, and their employment also improved and unemployment gradually declined.
Thank you for your answer. Now let us discuss the three major unconventional monetary policy tools: quantitative easing, negative interest rate policy, and forward guidance. So, Tasmin, could we start with the quantitative easing?
To talk about quantitative easing, it involves large-scale purchases of government and private assets by central banks to inject liquidity into the economy. Between 2008 and 2022, the Fed's balance sheet grew from under $1 trillion to over $8 trillion. The European Central Bank and Bank of Japan followed similar paths. Now, to talk about effectiveness, during this period, quantitative easing lowered long-term interest rates roughly by 1.5% and supported asset prices as Fed purchased around $600 billion treasury securities. In the euro area, quantitative easing like European Central Bank's asset purchase program, which was implemented in March 2015 and continued until the end of 2023, helped reduce borrowing costs significantly during this period and supported economic recovery, especially during the sovereign debt crisis.
Let me continue by talking about a negative interest rate policy. Negative interest rate policy means central banks set policy rates below zero, charging banks to hold excessive reserves. The European Central Bank, Bank of Japan, and Sweden's Riksbank all implemented negative interest rate policy after 2014. To talk about effectiveness of this policy, negative interest rate policy aimed to push back banks to lend more and weaken the currencies to boost export. In Sweden, negative rate combined with asset purchase boosted inflation and output, reducing government debt by about 5% of GDP between 2015 and 2019. Besides our effectiveness, there are faced challenges like it can squeeze bank productivity and distort financial markets, but evidence suggests it provides meaningful stimulus in the short run.
Forward guidance is also a tool of unconventional monetary policy, and it has become an essential part of monetary policy, especially during the time of economic crisis, because this unconventional approach helps the central bank to influence market expectations regarding the interest rate and policy action. The best example I would give is during COVID-19, the US Central Bank, Federal Reserve, they have reduced their interest rate excessively, whereby the inflation moderately exceeds 2%. From this, we can understand that this was enforced in various Federal Open Market Commission statement to the 2020 and 2021, helping to establish the financial market.
Thank you all for your answer on the three tools of the unconventional monetary policy tool. Now let us look at some real example and evidence. Interesting, as you mentioned earlier about the Sweden. Now could you highlight the Sweden experience?
In case of Sweden's experience, Sweden's Riksbank also Sweden's central bank combined negative rates of 0.10% in February 2015, which further lowered to negative 0.50% in 2016, with large-scale asset purchases from 2015 to 2019. So this mix boosted economic activity and inflation, while government debt fell by about 5% of GDP. So if Sweden had relied solely on fiscal policy, inflation would have risen less, and debt would have increased by nearly 8% of GDP.
Earlier, in the euro area, quantitative easing and other unconventional monetary policies significantly reduced long-term interest rate and stimulated asset prices, especially during the crisis. However, since 2015, the marginal benefits have declined, while risks like market distortion have grown.
Now, to talk about the real-world example of a way forward guidance of unconventional monetary policy, let me give an example on how the European Central Bank used way forward guidance in the economic. That was during the Eurozone crisis. The Central Bank of European they faced low inflation and a low economic growth, whereby their inflation was below 2% target, and some member of state was also at a risk of deflation. And in response to that, the central bank launched a large-scale quantitative easing program in March 2015, and it is also known as Expand Asset Purchase Program, initially purchasing a euro of 60 billion per month in the public and the private sector, whereby this goal of unconventional policy was to stimulate demand and investment and bring closer to 2% inflation rate and to reduce borrowing costs across the economic, whereby this was how way forward guidance was used by our Central Bank of Europe.
Thank you for giving the real-world example and evidence which are related to the three tools of unconventional monetary policy tools. So now let us discuss the broader implication. So what are the main benefits and risks of unconventional monetary policy tools?
Thank you, Tenzin, for the question. In case of quantitative easing, the main benefit is crisis stabilization, preventing deflation and supporting recovery. Unconventional monetary policies have become a permanent part of the central bank toolkit, especially when inflation is below target and growth is weak.
For negative interest rate, risks include asset bubbles, financial market distortion, and increased inequality. For example, quantitative easing boosted stock and real estate prices, benefiting asset owners more than wage earners.
Now, to continue, there is also risk of overburdening the central bank. Unconventional monetary policy are most effective when combined with the fiscal and prudential policy. Heavily relying on a monetary policy can create a long-term risk. Unconventional monetary policy works by lowering interest rate, boosting liquidity, and encouraging borrowing, spending, and investment. However, a central bank cannot fix structural economic issues such as low productivity, weak labor market, or inadequate public investment on their own. This required a coordination support from both fiscal policy and prudential regulation.
Telling the benefits or risks they face after using the unconventional monetary policy tools. So therefore, now let's address some questions. So first, are unconventional monetary policy still relevant in 2025?
Yes, it is still relevant. With global growth still uneven and inflation targets not always met, central banks continue to use unconventional monetary policies as needed. So the Bank of Japan, for instance, maintains quantitative easing and negative interest rate policy in 2025.
Despite our fantasy, it is still relevant in 2025, but central banks are also more cautious, aware of the side effects and the need for coordinated fiscal action.
Sanjay, what about the emerging market? So do unconventional monetary policy also affect the emerging market?
Of course, unconventional monetary policy in advanced economic significantly impact the emerging market by driving volatility, capital flow, and currency movement. During an easing phase such as US quantitative easing program post 2008 and COVID-19, emerging market experience a large capital inflow, currency depreciation, and asset price inflation. However, when this policy reversed, most notable during 2013 taper tantrum, many emerging markets including India, Brazil, Indonesia faced a sharp capital outflow, currency depreciation, and financial instability. This episode highlights how dependent emerging market can be on a global monetary condition, often facing effect despite not implementing unconventional monetary policy themselves.
Thank you, Sanjay, for telling that unconventional monetary policy also affect the emerging market, which also cause the capital flows and currency volatility. Now, to wipe up let's summarize some of the key points. Unconventional monetary policy tools such as quantitative easing, negative interest rate policy, and forward guidance were essential in stabilizing economics after the financial crisis. Some of the evidence shows that these tools were most effective during the crisis period, but their impact has waned over time and risks have grown. Unconventional monetary policy should be used alongside fiscal and structural reforms for maximum effectiveness. The future of monetary policy will likely include both conventional and unconventional tools tailored to evolving challenges. Now, thank you to our panelists for their insight and to our listeners for joining us. Remember that understanding the monetary policy is key to understanding the global economy. Thank you very much.